Welcome to PhillipCapital's Weekly Market Watch. The unexpected decline in June unemployment report and factories orders sent the market sliding lower. It appears that the US recovery is losing steam. Today, we have Mr. Donnie Liu, CFD dealer from Phillip Securities, to share with us.
The US Labor Department said that the private employers added about 83,000 jobs last month, and this considered fewer than the 112 jobs that analysis has forecast. This means that it could take years, not months, before the employment rate returns to pre-recession levels. New orders for factory products fall much more than expected in the month of May, posting their sharpest drop since the depth of the recession and their first decline in 9 months. Factory orders fell 1.4% in a month, the steepest drop since March of last year. Analysts were expecting a modest of 0.5% decline. With all these data shown, the economic recovery may begin to weaken, and it might be bearish for the short term. Overall, the sentiment remains cautious for the time being.
With the slower growth in China and the Europe debt crisis, do you think the US will have a double-dip recession?
The slower growth in China and the Europe debt crisis is having a negative impact on consumers as well as business confidence. However, I do not believe the US will have a double-dip recession because its economy is far larger and stronger. The US will be able to carry its debt load and will continue to slowly crawl out of recessions. The danger will be if the Federal starts to tighten too early. This would slow down growth and spending. There obviously will be ongoing problems such as the housing market and commercial real estate still face significant challenges. However, I do believe we could easily see an uncertain and volatile market in the US. The fact is that stock prices are way ahead of business earnings. The PE ratios of some stocks is extremely high. I believe the market has much further to fall because business profits cannot grow very well until consumers regain confidence to spend. In conclusion, I do not think the outlook for the second half is totally negative. We shall have more clues until we see next jobs and consumer spending reports.
What is your advice for investors in the coming months?
It is very hard to time the market and we will not know when is the bottom. But I think we are seeing a temporary slowdown in Europe and the US rather than a double dip that takes the GDPs down to zero or even negative growth again. Investors should invest in high quality stocks which have strong balance sheets and prospects of good earnings growth. I believe that the upside is still much more than the downside for the next few years.
Thank you, Donnie. That's all we have for you today. Tune in next week for more markets updates.